Okay, Mokama Sunday service. Today we're going to be talking about the top 20 stocks for the next 10 years. Got this idea from Earn Your Leisure. And as we were talking about this, where they were talking about 20 stocks that are better than Tesla. Also, one of the homies the other day asked me, like, what are some stocks that I should invest in? So I thought this would be a good topic for this week. Um, and so I kind of made a list. Before we go into that list, though, just in terms of standard disclaimer for those out there on YouTube and in other places, this is for informational purposes only. Investing, trading is risky. I am not a financial professional or advisor. You should always refer your trades and investments and review them with your financial professionals and advisors and do independent research. So, with that said, let's get started. The way that I kind of compiled this list primarily of these 20 stocks was figuring out like what companies that I perceive to have a moat. A moat being like this thing that they do or sell or a service that they provide where it's going to be really hard for anybody to compete with them over the next 5 to 10 years. And generally, those are the companies that are likely going to grow and get bigger because, it's going to be hard for people to compete. Um, and so when we're talking about moats, I kind of wanted to go sector by sector before I start going stock by stock. Let me pull up my notes. And I'm also going to look at the charts as well and then kind of chart these things while I'm talking about them. So just to get a sense, not just like of stocks that you want to own, but like also like what are the prices that you might want to look to buy these things long term or to trade them. All right, so let me go back. I'm gonna pull up Thinkorswim. Can you guys see that?
Yep.
Okay, so this isn't in any particular order, but number one we're going to start with is Nvidia, right? Everybody knows Nvidia. Everybody, and I'm like, you know what? I'm not even going to. What happened? Can you still see my screen? There was an error that popped up.
Yeah.
Okay, I think it's because it's after hours and Thinkorswim is doing some maintenance. But Nvidia, this is not in any particular order, but just for those who aren't familiar with Nvidia, they make semiconductor chips. They make the best semiconductor chips. Specifically, they are powering the AI race. And the reason why I have them as a top stock, if not the number one stock, but definitely a part of the top 20, is because they have this moat for these semiconductor chips that are powering cloud services, which is growing tremendously right now, as well as AI companies that are in an arms race right now. In order to power those two different industries and sectors, you need NVIDIA's chips. And the closest competitor right now is AMD. But every time AMD releases a new AI chip, NVIDIA releases an updated AI chip. And they're a little further along than AMD is. And their chips go for $10,000 to $40,000 of chips. And the companies that are buying all of their chips are the massive companies out there, the Metas, the Teslas, the Amazons, the Googles. They are all buying billions of dollars worth of NVIDIA chips to power their cloud services, their data centers, and their LLMs or large language models, which we know is like ChatGPT and the AI services that we actually know of today. So that's their moat. And I don't really foresee like any other company really overtaking them over the next 5 to 10 years. Like I said, number two in this space is AMD, but that's really it. So they're going to be number one or number two in this space, I think, for the foreseeable future. And they are getting the most benefit from the AI arms race. Um, and like the example that I like to give is the gold rush. Who got rich in the gold rush? It wasn't the gold miners. The people that got rich in the gold rush were the ones selling the picks and the shovels and the jeans, right? So it didn't matter if they struck gold or not. All of these people, and then go to a day chart. So where would I like to buy Nvidia for long term? Personally, I actually did get into Nvidia on this day. I bought 190 shares on this day. The reason why I did, because it hit that fib level, that 78.6% fib level, and so that was a point of entry for me. It's around the 50-day moving average. Where I would love to buy Nvidia would be at this 200-day moving average, and a lot of you know that's where I like to get in on a stock. But when was the last time Nvidia? Let's zoom out again. When was the last time Nvidia even touched that 200? Back in, what is this, January of 2023?
Yeah, no, it hasn't dropped that low. That's what I'm
That's
saying.
that's what I'm saying. So like, I never buy at all time highs. So the pullbacks recently have been a little bit below those 50s. If I had a 100-day moving average on the chart, it might be hitting that 100-day. But like, that's it, So that's why I hopped in. Like, I hopped in at a key level, at this fib level, to see if it'll hold. And where I would love to get in Nvidia would be at $87, but I don't think it's ever going to drop there. If it gets back to 100 again, I would love that level as well. But I like the level where it's currently at if the market's going to keep pushing up, because Nvidia hasn't touched that 200 in like a year and a half, right? So that's Nvidia. That's the number one, in no particular order, but just the one we're talking about, Nvidia. Second stock, TSM, Taiwan Semiconductor. We're still in the semiconductor space. Love Taiwan Semiconductor. It manufactures chips for Nvidia and a lot of the other major semiconductor companies, with like the exception of Intel, right? So TSM, the major issue that I have with this company, it's a great company, is the geopolitical risk. It's in Taiwan, and Taiwan says Taiwan is an independent country, and China says Taiwan is China. So that's the big dispute. And if China ever decides to invade Taiwan, the first thing that's probably going to get hit is the biggest company in Taiwan, which is Taiwan Semiconductor. And so this is why a lot of governments around the world want TSM to build fabs, which are essentially their manufacturing plants, on their soil. So like in Europe, in the US, and we're giving away tax incentives and benefits for them to do that, so that if China does decide to invade Taiwan, at least like our chip production isn't going to slow. And you got to understand that these chips are in everything now. I'm talking about missile defense, defense systems, planes, jets, in addition to cloud computing services and AI, large language model, like processing. Like chips, it's almost like the gold of the future. So Taiwan manufactures and has a better manufacturing procedure and has put in more money into these fabs than a lot of other companies in the same space. Not even a lot of other companies. There aren't that many companies in the space. And it's because the government of Taiwan a while back decided to actually help this company, and they invested a lot in the infrastructure. So that's why TSM is one of the best in the semiconductor space. So I just moved to and then kick them to TSM to manufacture them. So almost the entire semiconductor space has exposure to, China potentially invading Taiwan, maybe with the exception of Intel. Like, that would be my bet. I would probably go long Intel and short the rest of the semiconductor sector if I got news that China was invading Taiwan, right? So TSM, if we're looking at where I would potentially want to buy or enter, right? TSM really hasn't come back to that 200, but it actually, it has, what was this, November of 2023? So yeah, I I do like it where it currently is as like a point of entry because it's at this fib level right here. Let me go to a weekly chart, see if there's another level that I like. I do kind of like it right there at like 151, 150 if you're looking at weekly levels, because you had like this low right here, this closing price right here, and this low right here. So like in terms of the next stop, yeah, potentially at 151. But if you look, it's been checking back at this 21 week moving average right here, and we're there right now. So I kind of like, from this last pullback that we got on tech, I like TSM where it's kind of currently sitting, but maybe at like 155, 156 would be a good level for TSM. All right. All right, next stock. Something else that I just bought recently is ASML. I forgot to clear this one. You guys can still see my screen, right?
Yeah.
All right, ASML. What does ASML do? We are still in the semiconductor space. It makes the machines that TSM uses to manufacture Nvidia's chips. So we're just going to we're going deeper. It's in the same ecosystem though, right? So they make $100 million machines that they sell to TSM, which TSM needs to manufacture Nvidia's chips and other semiconductor company chips, right? So this is also a picks and shovels play. If you look over the last 5 years, the low was 191. The high was 1110. So you could have five extra money if you would have invested in ASML 5 years ago. And then as I'm seeing all of these governments investing in building these fabs or chip plants in their own countries, and they're giving tax incentives for them, you're going to need the machines to actually manufacture these chips. So I assume if all of these countries are investing in this infrastructure now because of the Taiwan and China issue, then every fab that gets developed is going to need a few of these $100 million machines that have the best technology to make these incredibly small chips that are powering the cloud services, data centers, and the AI revolution. So ASML is a play. It's a European company. I forgot where it is in Europe, but it's a European company that that creates the laser technology and the machines to build these chips. So if you believe the chip space is going to be strong over the next 5 to 10 years, which I do, then they are going to be a major beneficiary of this. And they have, like, I believe 60-70% of the market share for these lasers and the technology to make these chips. So they're like a part of the supply chain for the manufacturer of like Nvidia, AMD, and a lot of these other chips, right? So that's why I like AML or ASML. And let me do the fib levels, 191.25. And the reason why I'm drawing these fib levels for anybody that's new is to figure out if a stock is discounted and like how discounted the stock is, right? And they also tend to serve as support and resistance for a lot of different traders and investors, right? Like who are looking to get in around these same points. And so ASML, I bought some at like 888, which is right here at this 200 moving average, right? So I'm at break even. I bought it, I think, on this day right here. it came down a little bit. And then I'm looking too. This is where my stop was 850. It bounced right off 850. That's a great place to enter. If I would have held one more day, held off, like that probably would have been a better entry point, just because you see these lows right here that are like popping up at 850. So at the 850 mark, I do like, ASML. I'm already in this though, but that's a level that looks like it's been holding, and there's a couple of different support points in the past. If you go to a weekly chart, yeah, even these highs right here are kind of around that level. 850 is a really good level. I would really love it at 759, and it would be even better if it drops to 650. But look at the trajectory of this stock, as well as like the semi market. It's been hitting new all-time highs. So will it ever get all the way back down there? Who knows? This would be like the load the boat price would be at that 50% fib level. But will it ever get back there? I don't know. This is, I think, outside of like a geopolitical risk, or the government or governments banning companies from selling chips to China, which the Biden administration kind of has been. I like this kind of where it currently sits, and or at this next level here. All right, so that's ASML. Next one, moving on. Everyone should know about this company, Microsoft, right? Look at Microsoft's trajectory over the last 5 years, right? And now we're on number 4. So Microsoft primarily right now, like they make money off their cloud data centers, enterprise software solutions. That's Microsoft. And they own 49% of OpenAI, which is the company that created ChatGPT. So Microsoft is strategically positioned in the future to keep growing, and it owns a significant portion of one of the most revolutionary companies that has been created in a while. Right? I'm not going to say it's the MySpace of AI companies, but right now ChatGPT is like it was first to the space to actually figure out how to monetize AI, even though like IBM has had Watson for 10 or 20 years. But ChatGPT actually created a tool for consumers that it could monetize based upon like the new AI capabilities that are out there right now. But same thing with Microsoft, 468, 35, 130. I don't know why it's not clicking onto this low automatically. 130.78. Fib levels, go to a day chart. Microsoft has been checking back to the 200 more often than the Nvidias, right? If you see that, you guys see that on my chart? It's not touching, but it's checking back a little bit more than some of the others, right? So right now I like Microsoft maybe between, let's see, like 4. Is there any other levels right there? I like Microsoft between like maybe 403 and like 405 as a potential entry point. If we sustain this bull market and we keep going up, we're in a presidential election year cycle, which the market typically goes up from a seasonality standpoint. So from 403 to like 406, if Microsoft pulls back there, I kind of like that as an entry point. It's around that 200 exponential moving average. Microsoft hasn't gone below the 200 exponential moving average since like, what was this, like 2022? No, what is this? 2023. Since March of 2023, it hasn't hit below that 200. So if you're looking for the upside, you think the market's still going to go up. Yeah, I like it if it gets close to that 200, but it hasn't really been checking back all the way to that 200. So you might want to grab it a little bit before it hits there, right? But I like this low right here. If it ever gets back down to that low, which is around 405, that's when I would try to enter Microsoft. and even like getting close to 400. Like the market loves nice round numbers, right? If that drops to 400, that's like a perfect number for it to reverse on. Um, Two zeros, 400s, close to this fib level right there. I would really love it if it dropped to 400. But it may not. It might bounce just like it did on this day. This huge wick. If it gets down to 405, you might be too late. So it's one of those things like keep a risk reward, a certain risk reward ratio. Maybe you get in at 405, or you do a quarter or a half position at 405 and hope it keeps dropping down and get in closer to 400. But it may not ever get back to this 200 EMA because over the last year and a half, it'll get close, but then bounce right up right before it touches. So that would be my Microsoft. All right, next, moving on would be Apple. All right, Apple, as we all know, it's moat iPhone. Uh, right, huge market share of the smartphone market. It's either iPhone or Android. And Apple products are A1. Everyone loves Apple. The issue with Apple is they need to figure out how to innovate and get another vertical outside of their iPhone, because that's their one trick pony right now. But it is a successful moat that's been working really well. And as they start integrating AI features into the iPhone, then I feel like a lot more people are going to start renewing and or get the new iPhone in the next cycle once they start integrating a lot of the AI into the phone. And they're working with or partnering with ChatGPT and Gemini from reports in terms of AI rather than like building their own LLM. But Apple, if you look at their stock price, right, and look at the chart, and if you guys see a pattern in these stocks that I'm doing, you see the chart goes from the bottom left to the upper right, right? That's why I'm saying these things are the top 20 stocks. Like if you invested 5 years ago at $50, Apple is its high was 237, so that's what a 4 to 5x in your money. So that's typically what you're looking at when you're looking at these charts from a technical standpoint, not just a fundamental standpoint. Does the chart start at the bottom left and then go up to the top right? Likely that's a stock trending in the right direction. You want to catch these on a pullback, but ideally, like they're trending in the right direction. And if it's trending in the right direction, the trend is more likely to continue. So these are the things I want to grab when they're on discount. 48.15. All right. So where would I get into Apple? Crap. Looking at Apple, I really like this 165 level. Now I just because I've gotten in at this level a couple of times and I've done really well. If Apple drops down to that 165 level, Apple doesn't tend to even drop, like even during like really volatile periods. Apple doesn't ever like tank like all of the other stocks do. Even here, right here, this was when the market was doing really bad. Apple fell, but not like the rest of the market fell. So it's rare to see Apple more than like 20 to 40% off of its all-time high. So given that, these are these stocks like Nvidia, Apple that I don't think are that rarely ever come to their 200. Like I would rather take a stab at Apple maybe if it gets back to $200, right? Which is close to this fib level, and maybe even for a swing rather than a long-term investment. But for a long-term investment, I really love Apple. Like look at this level at 165. All these lows right here, kind of bounce off of there. These lows over here. I really like Apple. If it ever gets back down to 165, that's probably when I would go long Apple again. But more short term, that 200 level right here, which was like the old high, that looks really good. like to take this at least to swing it back up from 200 to see if it'll get back to 240. But yeah, the load the boat price on Apple right now would be about, like I said, 40% off of that all-time high right there. So if it gets back down to 165, you know, that's really when I would love to kind of hop into Apple, especially if we're still in a bull market. Okay, so moving on. Next one everybody knows about, Amazon. And right now we're on number 6. Amazon. Amazon, as you see, has been a little bit more rocky than Apple and Microsoft, but still, if you go look at a 5 year chart, if you invested in Amazon 5 years ago at around $83, you at least two extra money. And Amazon is a growth stock where it tends to dump all of its profits back into growing, rather than issuing dividends and things of that nature, right? Amazon is always trying to grow and get bigger. So if you look at it over a 5 year month chart, we're close to all-time highs. It still goes from the left up to the right, maybe not as much as the Apples and the Microsofts, in terms of their charts. Where would I like to get into Amazon? Amazon does check back, it looks like, to the 200. It does check back here and there, and it's a little bit more volatile. So I really like Amazon if it gets to 170, and you could probably take another stab at it at that 175 level, 176, 177, 175 to 177, and 170 to maybe like 172. Those are the levels I like Amazon at. Amazon's moat clearly is e-commerce. It's the biggest e-commerce site out there. No one's challenging Amazon anytime soon. And then number 2, and probably is number 1, is AWS, which is their cloud computing service. They pretty much revolutionized and kind of coined cloud computing and data centers coming from that. So Amazon, that's their lead, that's their moat. Like Microsoft, cloud services, Azure is number 2, behind Amazon's AWS. That's what I forgot to talk about in terms of Microsoft too. But like they're number 1 and number 2. It's going to be hard for anybody to unseat them. There's just so many massive companies that are running their companies off Amazon and Microsoft's like cloud computing services, and they tend to get bigger, and the revenue has been growing over the last few quarters pretty consistently. So Amazon. Google. Y'all following me still?
Yes, sir.
All right. Number 7, Google. I'm going to go on a rant about Google because we're going to clip this up. Everybody. So Google fell recently over the last week because ChatGPT, which is owned by, or a significant portion is owned by Microsoft, released Search GPT. And then people are like, oh my God, ChatGPT is going to unseat Google and search. And search is Google's moat. It has been Google's moat forever. And here's why I don't think that's going to happen, at least over the next 10 years. So people really have to understand Google's business model to realize like how much data that they have on you and I that puts them worlds in front of every other company that has been trying to get into this space. Like if you look at Bing, Microsoft has been trying to get into search and it just hasn't worked. So now they're trying to do it with OpenAI. Bing, I'm not going to say Bing failed, but Bing is not Google. When was the last time you Binged something?
Never.
See, so Microsoft is now trying to use OpenAI because Bing failed to unseat Google. So now OpenAI is their next turn to get into search because they missed it a long time ago when they were inventing Internet Explorer and Windows. They didn't realize that search was going to be as big of a market as it is, and Google came in and ate their lunch. And then you know what Google does? Google figures out what Microsoft is selling to people, and then it gives it away for free to drag people to its search. It did that with Google Docs, Microsoft Word, PowerPoint, Google Slides, email, Hotmail, Gmail, Internet Explorer, Google Chrome, right? So, and it does it better. And same thing with phones. So you got Apple iOS, Google Android. Android gives away its platform for free to phone manufacturers. Why does it do that? Because when you get your Android phone, which is the second most popular platform next to the iOS, Apple, it automatically comes with Google search on the phone because it's an Android platform, right? Versus you got to download the ChatGPT app and then start searching through that. And then so this is my rant on that. So because Google is so ingrained in everything that you do, how many of y'all got Gmail accounts?
I do.
And you got a Gmail?
Yeah, I did Gmail.
Yep. So we all have Gmail accounts, which means we're typing things into our email address. Google knows who's sending us emails. And so their ad platform is that much better. What does ChatGPT have from you that they're able to serve ads better than Google? Like Google, you've been in Gmail for I've had a Gmail account for over 20 years now. Google has over 20 years of data on me, right? I've been typing things into Google search for over 20 years now. Google has over 20 years of search data. I use Google Chrome as my browser, and it's because it's the best browser and the top browser. Google sees everything you type into your browser, right? So it just has way more data to serve better ads to you than any other company out there because of all of these things that we give Google on a day-to-day basis where they just know everything about you. Now, I know that's scary for a lot of people, but this is why I think they have the best ad platform is because they have the most information and data. And I don't care how great ChatGPT is, it's going to be hard to unseat Google, especially when they're developing their own LLM in Gemini, which works just as great as ChatGPT in certain instances. So, and it's going to keep getting better. So that's why I don't think that ChatGPT is going to unseat Google and search. Um, Another reason, when you search for Google, the main way that they make money is that businesses are paying them to come up in ads. So ChatGPT, I feel like is more of a functional thing or like a crazy question thing. Like if you're doing research, you're gonna potentially go to ChatGPT. If you're looking for a specific business to buy something from, I'm going to go to Google or I'm going to Amazon, right? Like if I'm searching for a plumber, am I going to go to ChatGPT or am I going to go to Amazon or going to go to Google? I'm probably going to go to Google and figure out who's the plumber closest to me. And guess what? Google has Google Maps. Does ChatGPT have Google Maps? No. So it's just like Google has just all, and they own Waze too. So they have just all of this data on us that tells us like whenever we go and search for a product or a service to buy, we're more likely going to go to Google. And until ChatGPT becomes that platform where you actually go there to search for services and products versus just you have this random question or you're trying to shorten your time on writing this paper or something of that nature or writing an email and having it craft responses for you. It's more of a utilitarian tool for me right now than like a search platform that's going to unseat Google when I know Google has the best data out there, right? Does anybody disagree with me on that?
Nope.
Right. So
Makes sense to me.
that's my rant on Google and so the stock dropped, which is what is giving everybody a chance on this pullback on Google right now, right? But that's why I don't think from a long-term standpoint that ChatGPT or OpenAI, which is really Microsoft, is going to take away Google's moat because they've been trying to do it for 20 years already. And Microsoft messed up because they were using Internet Explorer and all of their other tools to protect their cash cow in Windows when Google realized like who cares about the operating platform? We would rather have the browser. We would rather have the mobile operating platform, and we'd rather have search, and all of these things we're going to give away for free to drive search. So that's my rant on Google. I know we spent a lot of time on that, but I kind of
No,
like
that's a good game though.
I kind of like Google even right now at that 160, 250 level. Even better if it can get down to that 200 EMA at like 157 to 160. That would be a great level to catch Google at. If it comes back down there. People are bearish on it because of the GPT news, but Google keeps performing well if you look at their revenue. Their revenue keeps growing. And they're like, well, their revenue slowed. It was growing 13% per year. And now it's only growing 10%. I was like, yeah, but it keeps growing. I think they're going to be bigger in the future. They have $100 billion. We talked the other day, or if you looked at my video, they have $100 billion of cash and cash equivalents and assets on hand, like to invest or to buy things. And then if Trump wins in the next election, they're probably a lot of the M&A activity is probably going to go up. Recently, the Biden administration has been blocking any of these large companies from buying or acquiring any smaller companies because they don't want them to get bigger. And that's been for like all of these last few companies that we've talked about, right? So if there is a Trump administration, I wouldn't be surprised to see Google start going to try and acquire and buy things. It tried to buy something in the cybersecurity space the other day, but that deal may have fell through. And then there were rumors they were trying to buy HubSpot, and that deal fell through. So it looks like Google is trying to grow by acquiring companies in other spaces. Right. All right. Next, Meta. This is the second in the space. But it's social ads rather than search ads. Love Meta. That's its moat, and it's because it owns Instagram, WhatsApp, Facebook. It tried to buy TikTok, but the government blocked it from buying TikTok. So this is what I mean by like the government sometimes inhibiting some of these companies from growing the way that they would like to. And whether that's good or bad, I'm not going to reserve judgment on that, but it would love to have a monopoly on the social media space. Also, Google has YouTube. So just in terms of the competitors to Meta are really TikTok and YouTube right now. That's really it. But Meta's number one in the space because it owns three of the largest platforms of the social media platforms. Meta, as you see, had that dip, but it's been powering back. It's close to all-time highs. If you would have bought, 5 years ago at like 170, you would have three extra money, two and a half, three extra money. If we're looking at a level to potentially buy Meta, I love it. Almost got down there to that 200. I kind of like it where it was, on Thursday around 440. 5 would be a great level to get it. Even better if it can drop to that 200 at like 435, 433 to 435. Looking at these lows over here too, you know, that 430 is a decent price, but will it ever get back down there? I don't know, because recently it hasn't even been touching that 200. It's been bouncing before it gets there because it's been pretty bullish. So that's where I like Meta. Let's see. Next, which is number 9, Netflix. This is probably going to be one of my more controversial calls. I like Netflix. Like it came back up here. It crashed, then came back. I like it because I think it has a moat on streaming, right? If I imagine all of us, we have a lot of different streaming platforms and we might watch different things, but I would probably say that for the most of us, Netflix is probably number one. It's probably the first thing that we go to go check out new content. Right? Am I right or wrong about that?
I feel you right.
Right. I assume almost all of us have a Netflix subscription. And we have a Netflix subscription over a Disney Plus subscription. I have both, but you probably have Disney if you have kids, but you probably have both, right? So And then
Correct.
Apple just said that they're going to stop spending so much on content. And Paramount Plus, I'm just saying they're like 3 and 4 in the space. And I just feel like Netflix has kind of figured out the model of streaming, and they're probably going to be around for a little bit longer than all of these other players, and they're probably going to still keep leading the charge on streaming. You do have Amazon, but Amazon like does streaming and is getting these NFL and NBA deals to sell its Prime membership. Amazon wants to break even on all of these things rather than that being their primary business model. They're trying to get you in their ecosystem so that you use Amazon for everything. Netflix is just streaming, just content, movies, TV. I think it's number one in the space. I love the way it kind of picked back up. And like I said, Disney is the second company, and they haven't figured out even how to be profitable on streaming yet. So that's why I think Netflix currently has a moat. There have been other companies that have tried to come for it, and they haven't been successful, right? So that's why I like Netflix. If we're looking at where to get in, Netflix is expensive. I feel like it should split personally. The high, the low. $162. Try to get it approximately. See, go to a day chart. I like Netflix at the 200 too. If it could get down to around 570. I like it at 570. I also like it because you have a bunch of lows right here, and there was this gap right here. This is probably an earnings gap. I also like it if it can get down to like 541, 5 something around that, and 542. I like it there too. And then as like a load the boat price, where I think it's, buy more shares, would be around that 500 mark, right, on Netflix. But I'm always, we're still in a bull market, right? We might have had a few drops in this last week or two, but we're still in a bull market. Most things are still above this 200 moving day average. The market in general is above its 200-day moving average. So most of these strong stocks are likely going to go up unless we see the market turn for the worse, right? And then from a seasonality perspective, we're in an election year. The market tends to go up in an election year. So, and they're getting ready to potentially cut interest rates. So right now, at least into the beginning of next year or the end of this year, like I'm looking for things on these pullbacks rather than these far drops to like 50% levels or whatnot, where we would have to be in a bear market for that to even get down there. Now we can get to a bear market, but while we're still in a bull market, I do love things that are getting close to their 200 moving day average that are also good stocks. Okay, so we did mostly tech, semiconductors. Tech was like the second. Now for my number 10, we head into healthcare. Eli Lilly. Look at that stock. I love this chart. You would have got into Eli Lilly 5 years ago, you would have been up 9x. Eli Lilly is one of the leading companies in the healthcare space, and primarily manufacturing or trying to create drugs related to diabetes, weight loss, and dementia, Alzheimer related things. But Eli Lilly has been going crazy over the last 5 years. So love this stock. In terms of where it looks good, I love this fib level right here, because if you look at all of these highs in that range, so around 782 to like 785 would be a good place to try and pick up Eli Lilly on this pullback. And because look at this 200, it in the last year or two, it barely gets down there. Would love for it to pick it up at the 200, but it hasn't been there since March of 2023. So it's been a year and a half, year and a quarter since it's touched that 200. And look, that would have been a great place from a long term standpoint to enter is when it gets to that 200. But will it ever get there? Hasn't been there in a year and a half. It's been turning back at around that 50. And so now we finally have it below the 50, and it looks like old old resistance is new support. It was a huge resistance level that got rejected multiple times here during this period of the stock. And so, yeah, I love this fib level right there. If it gets back to that fib level of like 781, that would be a good place to kind of enter Lilly in this bull market. All right. All right, that's Lilly. Try to speed up. Same going to healthcare. My two favorite picks from the healthcare sector, Lilly and Novo Nordisk. They make all of these weight loss drugs that we've all been hearing about. Lilly has a competitive weight loss drug that is in development right now, but Novo has the top 3 or 4 weight loss drugs on the market. I think they own, hold on, let me. Novo Nordisk. Can you guys see my my browser?
Yeah.
Wait. I think they're Ozempic, Wegovy. See who owns? Yeah, it's Wegovy. They have the injection. Who's Ozempic? I think they're Ozempic too. And that's the most popular one right now is Ozempic. So that's the injection. I think Wegovy is the pill form. They were initially trying to develop these drugs for diabetes and then realized that they help people lose weight. And there was a bigger TAM on the weight loss market than the diabetes market. So now everybody, and there's shortages of these things. So now, like Lilly is trying to get a competitive drug in this space because they see how big the market is. So I love Novo Nordisk. It's not a U.S. company, but look at that stock price, right? Look at the trajectory of that. Weight loss has been huge. So 148 go down to 2386 or 6 whatever. It's approximately. Right? So where do I like Novo? Looking at this level right here around 120, 150, 122 looks like a key level that it's bounced off of relatively recently. If you look at the month chart, if you look at the day chart, that's where that 200-day moving average is too. It's right there at that fib level. And I love these double confirmations. You got a 200-day EMA that's right there in the same range as the fib level, the 78.6 fib level, and you had a bunch of lows in that same area. That's where I would probably look to pick up Novo Nordisk is around 120, 150 to like 122, 123, around there. All right, next stock. BRK or Berkshire Hathaway. And even though this is technically a stock, but the way Berkshire works, it's an investment firm. So really, it's almost like its own ETF, like of all the companies that Berkshire invests in. So it is a stock, but it's more of like an ETF. But as you can see, if you would have bought it way back when, it's $239,000 a share. You would have 3x your investment potentially. Warren Buffett, who owns Berkshire Hathaway, or he's the chairman, doesn't believe in doing stock splits. He has another class of shares that's a little less expensive than this, but he doesn't believe in stock splits or anything like that for the main shares of his company. The big risk to this company for me is Warren's death. He is over 90 years old. Charlie Munger recently passed, and they did name a successor, but is the successor going to be as good as Warren Buffett, the best investor in history? I don't know. But Berkshire owns huge stakes. They like dividends, but they own a huge stake in Apple, but they trimmed some of that. They recently trimmed their Bank of America stock. He invests in things like Coca-Cola, just standard things. Nestle, People are always going to buy chocolate even in recessions. They're going to buy Coca-Cola in recessions. That's what he tends to do. Safer dividend plays, at least over his lifespan. That might change with the new person that takes over once he passes, but that's the biggest risk to Berkshire Hathaway to me is Warren's death. And at 97,
Confirm the price on this stock. What's the price on this stock right now?
$657,000.
Oh, I've never seen this stock like. Oh wow, okay.
Here are the B shares. It's 437, but there's not voting shares. So they created this instrument for other people who wanted to own it. So you're gonna get like percentage points of the stock. But yeah, those are the B shares. Berkshire Hathaway. Next, JP Morgan. Big bank. It's the only one that I like long term. Not that some of like Bank of America. The reason why like Bank of America was doing pretty well recently, just to kind of compare charts. Let me see, BAC. But I don't like the fact that Warren Buffett just sold a bunch of shares in Bank of America and trimmed his position. Sold billions of dollars worth of shares. So JPM, if you look at Wells Fargo, right? Wells Fargo has been doing pretty well, but I don't like its history. Citi, right? So, but what's best in breed for the big banks? Look at JP Morgan. JP Morgan's chart looks way better than all of the big banks. And then anytime any of these banks get in trouble or financial institutions get in trouble, the government goes to JPM and gives them a sweetheart deal to take over some of the assets. I don't know why they always get the sweetheart deal, but for some reason they do. So that's why I like JPM. If you look at like 5 years ago, 100, you would have doubled your money if you would invest it in JP Morgan. And banks are usually a little bit more steady than some of these tech stocks and whatnot if you want to go like the safe route. But I think JP Morgan is the safest bank to go with. And where would I like JP Morgan? Same thing, around that 200. Hasn't been there since November of 2023. Either at this fib level right here at like 188 to 190, or a better level would be like around this 183.5 to 185, right? That's JP Morgan. Moving on, next one, which is number 14, Uber. I think it's won the race between Lyft, right? I know I use Uber more than Lyft, and not for any particular reason. It's just like when you think of rideshare, you think of Uber before Lyft. And unlike Lyft, it's also gotten into the DoorDash, Grubhub market too in terms of food. So like Uber has figured out how to grow more internationally than a lot of these rideshare services to increase its market share. It's finally got past some of the regulatory issues, specifically like in California and a lot of places in the US. And like I think it's best in breed for rideshare. And I assume all of us have used Uber probably within the last month or two, one way or another. So do I think this is going anywhere? No, I don't.
That's funny. I use Lyft all the time because I feel like Uber's more expensive.
It is, but I'm just saying in terms of like when you ask people, this is like Xeroxing something or Band-Aids, right? Those are brands, but when you say, even if you're going to use Lyft, most people say I'm going to go catch an Uber, even if they use Lyft, right?
No, yeah. I get what you're saying.
You feel me? It's like when you talk to people about ride sharing, and in terms of mind share, Uber is going to come up before Lyft does. They do have some competition, but they're number one in the space, and Lyft is number two, right? But Uber is far and above number one. And let's look at Lyft stock. Look at Lyft. Way different, right?
Yeah.
So it just shows you who's winning. Look at Lyft, where it started. It's high, and now it's at $12. Look at Uber, where it started, and now it's up, right? If you would have grabbed it at like 30, you would have 2.5 extra money. So Uber is just best in breed. And this is like a trade this, not that, or invest in this versus that. They're same types of companies, but I'd rather take Uber over Lyft any day. And then with the food delivery market, like Uber can still continue to grow. It could start delivering groceries. It has the infrastructure. Its app is a little better. It has multiple apps, right? Has a bigger driver pool. Um, and then once it gets bigger and figures out how to increase its margins, I think there's way more upside to Uber. And I just don't think that market is going anywhere anytime soon. Maybe the robo taxi upsets it, but I think they're positioned to take advantage of a robo taxi market more than anyone else because they already have the ridership and all of the data that everyone else is looking for. Right. So that's Uber. In terms of, did I say price already on it? Uber actually looks good to grab right now because it's at that 200 moving average, and you got lows in the same area around like $63. So I actually like Uber right now between 63 and $65. It's been pulling back to the 200 and bouncing off right here, over the last year and a half or two. That's been the key area to get in when we've been in the bull market. It's the 200. So Uber actually looks like a good long-term buy right now. Or if you really wanted to wait and hopefully it pulled back even more at maybe this level around like $57, $58 would also be a good place. Between 56 and $58 would be another good place to get into Uber if it even comes back down there. Right. What I don't like though, this high coming down and then you see a lower high, which means it might come down a little further. But I really don't want to see it get lower than this low right here around 62. If it gets below 62, it's probably coming down a little further. That's Uber. Next one, number 15, CMG or Chipotle. Chipotle's been killing over the last 5 years.
Right. Why is that? I've been hearing about Chipotle for a while, and I'm like, what's so special about Chipotle?
It's probably their business model, right? It's cheap business model. Like the stuff that they buy, chicken, lettuce, beans, that don't cost that much money. They got a great. There's always a line out the damn door during lunch. It's quick. It's easy. It's healthier, and so it's a healthier fast food than like a McDonald's, right? It's fast food, but it's not as it doesn't have as many calories or as many health concerns with like eating McDonald's or Taco Bell or something every single day, right? So it's Chipotle. So I think, and I feel like the person that eats Chipotle is probably a higher earner, so it's like the higher earners fast food. Instead of them going to McDonald's or Burger King, the higher earner is going to Chipotle for something quick because it's healthier. That's just my take on it. But this business model has just been doing really well. If you would have got in 5 years ago at $14, and yeah, you would have been like 3x, 4x your money at the high, 3x your money currently, right? And its earnings have been growing. I'm not sure if it's when it's reporting earnings next or if it recently did, but just looking at its history, like it's below its 200. So if it gets down to maybe, what's this, anywhere between 47 and like 46 and 47 looks like a good level because it's already below the 200. So yeah, and this used to be old resistance, so I like it around 47, $46. And it's getting exhausted too. So Chipotle. That's number 15. Number 16, Visa. Right? Everyone keeps talking about credit card debt is climbing. Credit card debt is an all-time high. Who benefits from it the most? Visa. So with everyone having all-time credit card debt levels, right? This is the company that you want to be invested in that's going to take advantage of everyone else who has a bunch of credit card debt. It's kind of steady as she goes. You got in for 170, you had almost 2 extra money right over the last 5 years. Steady as she goes, but Visa, incredible business. It just makes a small percentage point or a few percentage points or fractions of percentage points of these massive volumes of transactions around the world. because it kind of holds the rails, the payment rails, for you to be able to use your credit card in LA and in Switzerland and France all at the same time within an instant, right? So Visa, love the company. Its only competition really is MasterCard and Amex. And if we're talking about a good place to get in, it's below its 200. Kind of like this level right here, like 250, kind of a round number too. 250.
All right, fellas, I'm out of here.
All right, deuces. 250 would be a good place to get in, and or a really great level would be around 230 to 235, right here where a lot of these highs are here. Right. So that's Visa. The next stock, almost done. We're on number 17. American Express. Love American Express. Credit card company, same thing. It's going to benefit from everyone having more credit card debt. And this is more of the high earners credit card. The high earners more likely to have an American Express. So like their customer base is going to be better than a lot of these other bank stocks, credit stocks, things of that, like the SoFis of the world and the what's the other buy now pay later stock? Alliance. What is it? Alliance or no? Affirm. So this is going to have a better payment base than these other credit type of companies. Looking at it over the last 5 years, right? Let's say you bought 5 years ago, like 115-ish, you would have 2 extra money on American Express. Let's see, draw fib level. Bam, $67 is the low. Place I like it right now. Look at this 200 and a fib level conversion, and you see lows in that same area and old resistance in that same area. I love it between like 213 and 215. That would be another level to pick up American Express. All right, moving on. Number 18, Caterpillar. Right, machines other than John Deere is its major competitor, but it's number one in the space for like farming and agricultural equipment and supplies and things of that nature. If you look at it 5 years ago, you would have bought it at 110. You would have 3.5 extra money approximately. Right, so drawing the levels again. Bam, 87.5 approximately. Actually, I know where I want to buy it because I have an alert there already. I want to buy Caterpillar if it's around 315. All right, like I know that's my alert. And look, just because there's a monthly low, the last monthly low is there. Looking at a day chart, and it's around where these converge, right? This fib level and this EMA converge around there. At the time I was looking at it, it was around 315. So maybe I would probably raise this up to being right above that fib level. So I like 320. I like it at 320. That would be the place to buy Cat. Below the boat price be if it comes back down here. But then chances are if it comes back down here, we're probably heading into a recession or some big correction in the market, because recently it's been turning around at its 200. It might go a little bit lower than that 200, but it's been turning around there at the 200. So that's where I like Cat. Next one, number 19, Costco. I just invested in this the other day. Bought some shares. Did I? But yeah, I bought some shares in Costco. Reason why I purchased some shares in Costco is because I like this 50. Because recently Costco hasn't come anywhere close to its 200. October 2023 was the last time it even got close to its 200. Of course, that would be a better place to buy it. It would be around where these lows are and where the 200 is. So like, especially if it gets to 700, I love Costco. If it gets to 700, that would be a great price, nice round number to bounce off of. And these lows are concentrated in the same area. So I love Costco at 700. I took a stab here at the 50 mark just because I love Costco, and it's been tending to rally around the 50 day moving average. But like if Costco gets below 800, I'll cut it and then try to hop back in if it gets closer to 700. Just in terms of like uh, how I'm currently investing or trading Costco. But I think I got it on this day. I bought it at 830, right there at that moving average, at that 50. Because as you see, that's where it's been rallying recently. It's been rallying at the 50, not at the 200. That was the last time it got close. But yeah, I would love it at the 200, but it's so far from the 200. And this is a great stock. I don't know if it'll ever get back down there. And then last in my top 20, and as you see, Tesla did not make it. Last in my top 20, Walmart. Boring as she gets, boring as she goes. But man, if you would have bought Costco at $34 and it's at 70, you would have 2 extra investment in 5 years, right?
You mean Walmart?
Yeah.
You said Costco.
Those are the last 2, Walmart and Costco. But Walmart's number 20 for me. Love Walmart. It's not as a company and what it does all the time, but it knows how to make money. It's had some issues in the past, but in terms of like returning your investment, Walmart knows how to return your investment. Its moat is pretty much in-person store sales, same as Costco, but Costco kind of targets a higher end customer and sells things more in bulk. You're going to find the lowest prices, and you're also going to find the everyman there at Walmart. Everybody shops at Walmart. The big super centers, big stores, right? So love Walmart from a stock standpoint. And if you go look at where I would try to get in, same thing, probably would treat this more like Costco too. It hasn't pulled back to that 200 since last year. But would love it at the 200 if it ever got back down there. Let's see, look at a weekly level. Would love it if it got down to like 58, they say to $60, around this range where all of these lows are concentrated right here. Will it ever get there? I don't know. So, because we're still in a bull market. So from like a bull market pullback, I don't know, that feels a little aggressive too. I like it maybe around this level, at this fib level, where it gapped probably after earnings. I like it if it gets back to where it gapped up, maybe to like 63, $64 on Walmart. All right, that's number 20. I kind of wanted to just do rapid fire today and just like, hey, here are like 20 things that I'm usually always looking at. And I'm always looking at more than those. Like you'll see, I love Elf personally. If you look at my watch list, other things that I've been watching, I love Elf. I love CRM long term. I love HubSpot long term. I love SMCI long term. SMCI could have easily made it. I love some other stocks like Thermo Fisher, TMO, Adobe, Home Depot. But those are like my 20 that I feel like are going to get bigger in 10 years or are going to make more money in 10 years, that have figured things out. Walmart even figured out the e-commerce thing, even though the Amazon came in and took its lunch initially. It's finally starting to figure out e-commerce and deliveries and things of that nature at Walmart. But yeah, those are my top 20. Any questions?
Nice. So I got a question. So like this is like what you would say, like if you're building a long-term portfolio, these are your top 20 stocks that you're investing in and grabbing them at lows. So it could be 5 to 10 years from now, you're looking at a long-term retirement.
Exactly. If I were to build my own ETF, it would probably consist of these 20 stocks.
Nice way to put it. Okay.
Right. That's what I would probably put these 20 stocks in there. And then it's and I diversified too. I didn't just give y'all all tech. I gave you some healthcare. I gave you some standard brick and mortar. Walmart.
Also,
go ahead.
Oh, sorry, I didn't mean to cut you off.
Go ahead.
I was gonna say, and also, just confirming for people who will be listening that you review the fundamentals of these companies, and then do you, or actually, this is a question: do you look at the fundamentals and then look at the charts?
Yes, generally that's what I'll do. And like me, I've been tracking all of these companies for I would say at least 2 or 3 years now. The only
Yeah.
ones that I would say are newer to me that I haven't been tracking, because you see they've been on my watch list forever. It's probably Chipotle. Everybody's been talking about that, so I finally started looking at his chart and I was looked at the growth. But all of the other ones I've been tracking, and like most of them have great balance sheets and actually make money. They're not pre-revenue. Even the ones like, I'm in a Shop Leap right now, but I didn't put Shop in there. Shop is probably if I had my top 30, top 50, but in terms of like kind of can't miss or things that I think are likely going to be larger, or companies I think that are going to be larger in 5 to 10 years, this is what those consist of. Now there might be other stocks out there that are more discounted that pose a better risk reward to me in terms of getting in, but that I might not intend on holding longer than until when I hit my target, like on Shop. But yeah, I'm generally every single time I see these companies, these 20 release earnings, I'm gonna go look at them. I'm gonna go look at the earnings. I'm gonna go look at how much money they're bringing in, whether revenue is growing, how much cash they have on hand, what are their margins, especially as it relates to their competitors, right? Like you see, I took Walmart and Costco, but I didn't take Target or like Kohl's, right? Because I think those two are better than Target and Kohl's. Like if we go look at TGT, Target has worse fundamentals than Walmart and Costco. So they're in the same space, but I'd rather be in Costco and Walmart if you look at their stocks versus Target. And they also have better fundamentals than Target too. If you go look at their earnings reports, like Walmart makes more money and is more profitable, and Costco makes more money and is more profitable than Target. So if I were in the consumer space, the big box retailer space, I'd rather own Costco and Walmart versus Target and Kohl's or something of that nature, or TJ Maxx or whatever, you know. So yes, and generally like these all being in the top, I'm just trying to see maybe other than healthcare, because a lot of times they're trying to spend a lot of money in developing revolutionary drugs, and then with patent issues, some of those financials might be a little less pristine than like an Nvidia. But most of these companies, I'm just looking, they all have really good balance sheets, and or are profitable or making money, have a lot of cash on hand. And more so, like I said, the reason why I pick these companies is because I think they have a moat. It's going to be hard to come into their space and compete with them without spending billions of dollars and decades trying to get as good as them. Who do you think is going to come in and beat Costco at its warehouse and subscription game? Who do you think is going to come in and be able to outshine Walmart or Amazon or Microsoft or Apple in their specific niche? Google and search, Netflix and streaming, Novo Nordisk and weight loss drugs, Lilly and diabetes and dementia, Alzheimer drugs, JPM and JP Morgan and banking, when they're getting all the damn government deals, Uber in rideshare, Visa in the credit card space. So they're like number one or number two in their space, and it's going to be hard for somebody to come in and take their lunch. So ideally, they just keep increasing market share because they're the number one in their space. They have a moat. Nobody can do what they do better than anyone else. No one can do what they do without spending billions or trillions of dollars trying to catch up. Right?
Nice. Good game today. That's a great game.
All right, that's it for this weekend. For this weekend, Mokama Sunday service, making it rain without the umbrellas. Next time, if anyone wants to get on the Zoom and ask any specific questions, leave a comment in the chat, or not in the chat. Leave a comment on the video with your information, and I will shoot you a DM, email, or whatever it is. Right. So. That's that, and I think this is very like instrumental. I think these are the companies people should be looking at on pullbacks, Never buy at an all-time high. But if you see one of these good companies pull back, it's time to take a shot, you know. And as you see, sometimes these things take off. Like that Nvidia, I bought some Nvidia shares the other day. That thing was there for 2 seconds. This is when I bought it on this candle at 108. It was there for 2 seconds and came back up. Sometimes they bounce like that. Sometimes they're not going to be around for multiple days. So this is why you want to have your levels already set, already have your mind made up as to where you're going to buy something, set a stop loss and have, you know, what your risk reward is. So when something actually hits your price, you get in before it's too late. Because a lot of times these things bounce and they take off and they never come back. So doing the research, having your levels set ahead of time and kind of knowing, hey, this is where I said I was going to get in. And then when it hits that level, I just pull the trigger and just keep a stop. Sometimes I'm going to lose a couple $100. Sometimes if it bounces, I'm going to make a few thousand because of my risk reward ratios.
And so again, with a stop loss, is it to set it up? Do you just you'll activate an order to purchase a stock at, let's say, a higher price, like at $80, and then you'll at the same time set a sell order to sell the stock at like $78, like simultaneously?
Yes, but I would say for people who are beginning, yes, you want to do that. I set alerts for myself now rather than actual stop orders on a lot of things. Depends on
Just
what
to see if like you're like, oh, let me see if it goes to 77.50.
Yeah, or let me go look at the chart and see if it's exhausted. If this RSI is at like 20 and way down here and it looks exhausted, I might give it an extra dollar, you know, to see if it'll bounce, right? So I want to alert myself to look and see, hey, is this at a level? But if it's not exhausted, if it's still at the RSI is still at like 50, I'm like, oh, this thing could keep coming down. I might cut it, you know. Or if I see it makes a new minor low and then bounces, then if my stop was at 110, maybe I'll adjust my stop to where this low was right below it, you know. So it just depends. So, but I would say if you're new and or if you're in the middle of the day and you know that day you're not going to be able to look at your phone or a chart or your computer, yeah, set a stop. So just in case, like you don't lose your shirt, you don't lose all of your money. If your hypothesis is wrong, you're just wrong. Lose a couple $100 and move on to the next trade, or wait for it to get down to the next level and try it again.
I like it.
Yep. But your goal is to because even for this, so my hypothesis on this was that Nvidia was going to turn around at around the 110 level. It got there and kept going. So I was like, great. Shoot, I'm going to be able to buy this for 108, 109. I let it kept going. Then it bounced a little bit. I got in at like 108. So I got it close to that low where it was bouncing because my alert went off. So my alert went off. I didn't just buy at 110. I waited for it to keep going down. It looked like it was mad exhausted that day. In fact, I'll show you. What's it? I have an hour. I usually go to the 5 minute. Let's do an hour chart. It was on this day it went that low. I think I got in on this candle. But I saw right here, like this RSI hit like a low point. And it was in the morning. I was like, oh, hit my level. It triggered at 110. My alert was at 110. It triggered. And yeah, I decided to get in this candle or this candle when it was way down here around 1.8. Grabbed it, you know. And so I might go into a smaller time frame too to see if it's exhausted, which is the more exhausted it is, the more likely it is to bounce, which is an extra confirmation that, hey, this is probably a good level. And yeah, and then I'll try it out. And my goal is to at least get rid of half of my position when it hits that all-time, if it hits that all-time high again, or maybe even cut it a little early right here at this candle at 135. But let's say if my target one was 140, that's, let's say 110 and 140 is $30. And let's say my stop loss is at like 105. So that's like losing $3 to make 30.
Have fun, enjoy yourself. It's nice to see money.
Right?
Makes sense to me.
Yeah.
Yeah. Okay. All right. That's it for today. We've been going for an hour and 30 minutes now.
Nice job, man.
Yep. Next weekend, 8 a.m., same time, same place. Deuces.
Yeah, love it.
Yep.
I appreciate it, brother.
Yep. Appreciate y'all too. Peace.
All right, cool. Gone.